The Little Book of Common Sense Investing, The Simple Path to Wealth. Why should you read this book? Imagine working hard for decades, diligently saving for retirement, only to find that your investments haven't grown as much as you expected. Maybe high fees have eaten away at your returns, or perhaps you've tried stock-picking strategies that failed to beat the market. This is a frustrating reality for many investors. The financial industry often portrays investing as complex and requires expert knowledge. As a result, people turn to expensive financial advisors, high-fee mutual funds, and risky stock-picking strategies, all of which often lead to disappointing results. But what if I told you that investing doesn't have to be complicated? John C. Bogle, the founder of Vanguard and the pioneer of index fund investing, reveals a simple, low-cost, and effective way to build wealth. His book, The Little Book of Common Sense Investing, debunks myths about investing and provides a straightforward strategy to grow your money reliably over time. If you want to build wealth without constantly monitoring the stock market, avoid common investing pitfalls that cost people millions, grow your retirement savings with minimal effort, invest wisely without needing an expensive financial advisor, then this book is a must-read. The problems we face and how this book provides solutions. 1. The myth of beating the market. The problem. Most people think you can choose the best stocks and find the market from time to time, or find a superstar fund manager to get rich. You watch financial news, follow hot stocks, and often make emotional investment decisions. But the truth is that most investors over the market in the long run are surrounded. The research consistently shows that 90% of aggressively managed investment funds are below average after sub-average fees and expenses. The solution. Instead of trying to pick winners and losers, he recommends investing in low-cost index funds, which track the entire stock market. By doing so, you eliminate the risks of bad stock picks, poor fund manager decisions, and high fees. Example. Imagine you're at a horse race. Most people bet on individual horses, stocks, or actively managed funds. But Bogle suggests you bet on every horse in the race, the total stock market. Some will lose, some will win, but in the long run, you'll capture the overall market growth, which historically has been around 7 to 10% annually. 2. The cost of high fees, the silent wealth killer. The problem. Many investors unknowingly lose hundreds of thousands of dollars to hidden fees. Most actively managed mutual funds charge 1% to 2% in fees, which may not sound like much, but over decades, it significantly reduces your returns. Example. Imagine you invest $100,000 in a fund that returns 8% annually. If the fund charges 1.5% in fees, your actual return is 6.5%. Over 40 years, instead of growing to $2.17 million, your investment grows to just $1.47 million, a loss of $700,000 due to fees alone. The solution. Bogle stresses the importance of keeping costs low. His advice. Avoid actively managed funds that charge high fees. Invest in low-cost index funds with expense ratios below 0.1%. Stay the course and let compound interest work for you. By simply choosing a low-cost index fund, you can keep more of your hard-earned money and retire wealthier. 3. The dangers of market timing. The problem. Numerous speculators freeze when the stock showcase crashes and offer their ventures at the most exceedingly bad conceivable time. Others attempt to bounce in and out of the advertise based on forecasts, trusting to purchase moo and offer tall. But considers appear that most advertise clocks conclusion up losing cash. The greatest stock picks up frequently happen right after advertise crashes, and lost fair a couple of these enormous days can radically lower your returns. Example. If you invested $10,000 in the S&P 500 in 1980 and left it untouched, it would be worth over $900,000 today. But if you missed just the best 10 days of market gains, your returns would be cut in half. The solution. Bogle's golden rule: time in the market beats timing the market. His advice is simple. Ignore market noise and short-term fluctuations. Invest regularly, no matter what the market is doing. Stay invested for decades, not months or years. The stock market is volatile in the short term, but over time, it has consistently gone up. Those who stay invested through crashes and booms are the ones who build real wealth. 4. The simplicity of passive investing. The problem. Wall Street and financial media make investing seem complicated, convincing people they need experts, complex strategies, and expensive advisors to succeed. But in reality, simplicity beats complexity. The solution. Bogle's investment strategy can be summed up in 3 steps. 1. Invest in a total stock market index fund, like Vanguard's VTSAX or the S&P 500 index fund. 2. Reinvest dividends and keep adding money consistently. 3. Hold your investments for decades without selling. That's it. No stock picking. No market timing. No expensive advisors. The result? You outperform most professional investors while spending almost no time managing your investments. 5. The psychological advantage of index investing. The problem. Investing is emotional. When markets crash, fear sets in, and people sell. When stocks are soaring, greed takes over, and people chase risky investments. These emotional mistakes destroy long-term returns. The solution. By investing in index funds, you remove emotions from investing. You don't have to worry about individual stock crashes. You avoid chasing hot stocks or trends. You stick to a long-term, stress-free strategy. Bogle's approach protects you from your worst enemy, your own emotions. Final thoughts. Why this book can change your financial future. The Little Book of Common Sense Investing isn't just a book, it's a roadmap to building lasting wealth. By following Bogle's simple principles, you can build wealth without stress or complexity. Avoid common investing mistakes that cost people millions. Keep more of your money instead of losing it to fees. Retire years earlier with a larger nest egg. Most people spend their lives worrying about money, chasing the next big stock, or paying hidden fees they don't even realize exist. But Bogle proves that investing doesn't have to be difficult. In fact, the simpler your approach, the richer you'll become. The key takeaway. You don't need to be an expert to succeed in investing. You just need to be smart enough to follow a common sense approach that actually works. Start today, invest wisely, and let time and compounding do the rest. Your future self will thank you. Thank you for watching. I hope you found this summary of The Little Book of Common Sense Investing valuable. If you enjoyed it, don't forget to like, share, and subscribe for more insightful book summaries. Let me know your thoughts in the comments. What's your biggest takeaway from this book? See you in the next video.